On last turn, I discussed risk analysis. I discussed various types of risk in finance or specifically investment. The broadly in investment or in finance, risk is classified as systematic risk, which works like a system where all the industries or entire economy is affected. Unsystematic risk, which is unique and it is confined to one particular specific firm or maybe particular specific industry. And I quoted one example, like suppose coronavirus, it has global impact, it has global effect, and you can see the impact of coronavirus on the performance of most of the companies, especially which is reflected by stock indexes of the country. Sensex and Nifty crashed. So we can say that is systematic risk. It works like a system where all the companies, all the firm, most of the sectors are affected. Unsystematic risk, it may be very firm specific risk, like take the example of Yes Bank. The moment the problem was noticed in Yes Bank, it affected Yes Bank and to some extent other banks. Those were private banks. So that was unsystematic risk. Other businesses were not affected much. So in short, I discussed interest rate risk, market risk, purchasing power risk, business risk, financial risk, operation risk, and you can go through my video, which is uploaded at YouTube, and I also shared the link of my channel. If you just type Professor Mohd Shamim, Department of Commerce, A.M.U. Aligarh, you will get my channel, and whatever I delivered in the class, in this Zoom mode class, I uploaded the video, so that this video also I will upload. So it has already been discussed, and these are the various causes of risk that I will discuss later on. It's not, you can understand yourself. Now we are talking about risk management. A layman has to adjust with the risk which is associated with the investment, but being a professional, you have to work on management of risk also. You have to make effort, as investment deals with commitment of fund on the basis of systematic analysis or inquiry or investigation at appropriate time in diversified way with the objective of maximization of return and minimization of risk. As an investment professional, you have to make effort to minimize risk also. And for that, you need to understand various forms of risk associated with the investment. So you have to study about risk management. First thing is you have to identify what kind of risk is. Risks are of various forms. Unless you are able to understand what kind of risk is existing, it is systematic or unsystematic, it can be controlled or it cannot be controlled. For example, you came to know it is uncontrollable risk and you are making efforts, so that will be in vain, that will be waste. Your entire effort will be waste. And if you came to know the risk is controllable, but you think it is a systematic, you are not doing anything which would have been controlled, so you will be loser. Loser means you will not justify your client who is totally relying on you as an investment advisor or investment consultant. And that's why you have to go for risk management. You have to assess what kind of risk is there, its intensity. You have to identify what form of risk is persisting, and then only you can adopt a proper control system to minimize risk. So this is and that's why you have to know how to measure the risk. The intensity of risk may be low, intensity of risk may be high, and measurement of risk is important from decision making point of view. Once you are able to know the risk factor, measurement of risk means in quantitative form, how much risk is associated, you have to calculate, which is not possible for a layman. It needs a lot of knowledge, wisdom, and experience, and that will be very important for you to know the measurement of risk. Return can easily be calculated on the basis of past performance. Suppose ONGC is a company how much return you are expecting if you invest in ONGC. What you will do, you will calculate the average profit of 5 years or 10 years of ONGC. Suppose it is 18%. 18% is the average profit of ONGC in last 10 years. So what is average profit? The same profit you are expecting in future. So your expectation is to earn 18% return in ONGC. And with this expectation, you have committed fund in ONGC. But what about risk? Normally we do not make any effort to minimize risk or to assess risk or to control risk, or we never think about risk. We think whatever risk is associated, we have to compromise. You have not to do so. Like return can be calculated in quantitative form. Similarly, risk is also calculated or can be calculated in numerical form. So that technique you will learn in this topic. Suppose there are two options. Once again, try to think, or you may write on your notebook. There are two options, A and B. These two are the companies where you have to invest. Now, expected return in these two companies, in company A, expected return is 20%. In company B, expected return is 25%. Now, next item is risk. How much risk is associated with A and B? The risk factor numerically expressed is 2.5 in A and 6 in B. 2.5 in A and 6 in B. So 20% return at 2.5 risk. This one is better option. Or 25% return at 6. At 6 numerically expressed risk. So obviously first option is better. Why it is better? Return is 20%. Return has increased from 20 to 25%. There is upward movement of 25% in return. That's fine. But if you see how many fold risk has increased from 2 to 2.5 to 6. So approximately 3 times risk factor has increased. 300%, or you can say 280% risk has increased. So it will not be a good decision to go for B option. So A option is better. And how could you decide? You could decide on the basis of numerically expressed risk factor. And that's why this topic is important for those who are interested to make career in the field of investment. Now, the first important tool for measurement of risk is standard deviation, which you have studied in statistics. I think all commerce students have studied statistics. Now, what is the standard deviation? Don't think, or whenever you have studied statistics, your effort should have been to learn use of statistics in business, not only statistics. Statistics is studied by many students in the field of science, social sciences, commerce, management. Everyone is studying statistics. But question should be in your mind, why you are studying statistics? You are the student of commerce. Your objective of studying statistics is to know how statistics will help you in understanding problems of business or giving solution to the problems of business. So standard deviation is one of the tools which you have studied in statistics, like measurement of central tendency. You have studied. Under this, you have studied mean, median, mode. And very next unit is measure of deviation or measure of dispersion. In that, you have studied range, quartile deviation, mean deviation, and standard deviation. Statistically, it has been proved by the expert that standard deviation is the best tool to measure variation. So it is not your concern to know why. Whatever has been suggested by experts of the field, you have to consider, you have to obey. So I agree, standard deviation is the best tool, and that's why standard deviation is used in investment. When we calculate mean, suppose mean of company A, mean return of company A for last 5 years is 20, and mean return of company B for last 5 years is also 20, and mean return of company C for last 5 years is also 20. So if you apply knowledge of mean only, you will come to know that all these three are equally graded companies in terms of return. But if you apply further knowledge like a standard deviation, if a standard deviation is different from all the three companies, so it will be easy for you to take decision that which one is the best investment option, A, B or C. Mean is same, but a standard deviation, like in this example, there are two companies are quoted, A public limited company and Z public limited company. Mean return, mean means the past performance, and same you are expecting in future. So you are expecting 20 as the average profit of last 20 years. So the same return you are expecting. In case of Z also, same return you are expecting, but a standard deviation is different. 4.47. If answer, when you apply the formula of a standard deviation, if answer is less, it means variation is less. The data on the basis of which you have calculated arithmetic mean, on the basis of same data, if you calculate a standard deviation, it is 4.47. In case of Z, it is 6.71. So deviation, if deviation is more, it means uncertainty is more. If answer is less, it means it is looking more certain. If answer of a standard deviation is high, it means degree of certainty is less. If a standard deviation answer is low, it means degree of certainty is greater. So in this case, A is the better option for investment point of view. So if you apply your knowledge and take decision, so in long term, you will be more successful. This is another example I have taken. Suppose there are three companies listed at a stock exchange, ONGC, Hindustan Unilever Limited, and DLF. These are the return of last 6 years in all the three companies. Last 6 years. These are the returns of last 6 years for these three companies, ONGC, HUL, and DLF. So n number of years we have taken for all the three companies, that is 6. If you calculate mean return, actually mean return is the rate of return which you are expecting in future on the basis of past performance we are expecting in future. So mean return is 20, 20 and 20. So if you don't apply your knowledge further, all the three companies are equally good for you, but it is not so. The more knowledge you apply, the better decision you will be able to take. If you apply knowledge of a standard deviation, you calculate, already it is calculated. I'm not going through the formula. It is assumed. Whenever you will get opportunity to calculate a standard deviation, you can easily calculate with Excel or with computer or manually, or there are many other softwares in statistics. So it is 7.18, 1.79 and 30.72. What does it mean? HUL, the 20% which you are expecting in Hindustan Unilever Limited, its standard deviation of the return is 1.79. It means variation is less, deviation is less, and that's why degree of certainty is more. In case of, and you can see the data, 1921 in Hindustan Unilever Limited, 19, 21, 20, 22, 17, 21. It's looking very consistent. And that's why standard deviation is less. In case of ONGC, it is 12, 14, 21. See variation, highest and lowest. If you check, 12 is minimum and 32 is maximum. So deviation is more. In case of DLF, variation, the lowest is 21 and highest, you can say lowest is minus 23 and highest is 53. So deviation is 76. So the more deviation means more standard deviation. More standard deviation means more uncertainty. So is it clear to everyone how standard deviation will help you? Is it clear?
Yes, sir.
Okay, thank you. So I go ahead. Another one you have studied, coefficient of variation, right? in statistics you have studied standard deviation upon mean into 100. That is a standard deviation upon mean into 100, coefficient of variation. And before this, one more thing I would like to discuss. In this slide, you have studied mean, standard deviation, and there are many more things you have studied, like skewness. Have you heard? Have you studied ever? Skewness.
Yes, sir.
Suppose there are two companies, A and B. Expected return or mean return is 20 and 20. Standard deviation is same, 1 and 1. Mean return is 20 for both the companies. Standard deviation is 1 for both the companies. It means both the companies are looking equally good, right? But it is not. But it is not so. Further knowledge you have to apply. The more knowledge, as I told you, the more knowledge you apply, the more appropriate decisions you will be able to take. So you have to apply skewness in that case. Suppose 20, 20, average return is same, standard deviation 1 and 1 is same, and skewness is -1 and +1. -1 and +1. For company A it is -1 and company B it is +1. So the skewness where it is in negative is better. How? Suppose average profit of last 5 years is company A 18, 19, 20, 21, 22. If you calculate average of this, it will be 20, 18, 19, 20, 21 and 22. These are the return of last 5 years for company A. Average is 20 and standard deviation, for example, if you calculate, it is 1. There's another company B. Profit of last 5 years is 22, 21, 20, 19, 18. Average will be 20 and standard deviation will also be 20. But if you analyze which one is declining company or which one is growing company, in case of company A, first year profit was 18, then 19, then 20, 21, 22. So that thing, if you calculate a skewness of company A, you will get negative. And if you calculate a skewness of company B, you will get positive value. So, you know what managers do? They just call some of the subordinate and do assignment. Okay, go and calculate mean, standard deviation and skewness. And those employees are not aware of what for. Only they know how to calculate. Manager is looking only answer, mean, standard deviation and skewness. On the basis of these answer, manager is able to interpret, manager is able to take decision. And finally, credit will go to manager, right? So you have to apply skewness also. Then coefficient of variation, like in this case, I have given one example, company A. Suppose first option was stock, investment in a stock. Standard deviation was 10 and mean was 14. So coefficient of variation was 71 point something. And ETF, exchange traded fund, this is one of the financial instrument where investment can be done. Standard deviation is 7 and mean return is 13%. So it is 53.8. And coefficient of variation for bond, standard deviation is 2, but mean return is 3. So on the basis of mean and standard deviation, if you want to know only one value, applying mean and standard deviation, based on that, coefficient of variation can be used. So 71.4, 53 and 66.7. So ETF is better investment avenue if you are using coefficient of variation. If you are not using it, if you are not using statistics in decision making, your decision may be wrong. Your decision will be based on only guess, only tips and rumors, or somebody say, you make investment in company X or Y. So you have to apply your knowledge, you have to apply your wisdom, your knowledge of different subjects on the field. This is another tool which measures the risk factor, beta coefficient. You know, beta is representing market risk. Suppose you have a stock market, so beta is representing the stock market risk as 1. Beta is represented by 1. So 1 means market risk. And market comprises of number of individual firms. So what about risk associated with company A, B, C, D, which are part of the market? So you will come to know, in case of company A, beta factor is 0.8. In company B, it may be 1.5. In company C, it may be 3. So beta represents sensitivity. How sensitive your investment in a particular firm is in regard to market. It is calculated by, suppose there are covariance between return of a stock, that is RS means return of the stock in which you have invested. This is the share of a particular firm, and RM. There are two things. One is when you invest in a stock market. So stock market is also subject to variation. The stock market indexes are subject to vary. That is represented by, or a stock market is also offering you return. That is RM. And return is offered by your stock in which you have invested. That is RS. So covariance you have to calculate upon variance. This is the formula. So exactly if you want to know the beta factor of the company in which you have invested, it is on the basis of beta factor. So beta factor will guide you how much risk you are taking, how much return you are expecting. Another one is like probability technique. In case of probability, what happens? Suppose there are two firms, A and B. Expected return in A is 20%, in B 30%. And probability of getting 20% is 0.8. And probability of getting 30% is how much?
0.5.
0.5. 0.5. So if you apply mathematical expectation, 20 into 0.8, how much you are expecting? 20% you are expecting, and its chance of getting 20% is 0.8, and chance of getting 30% is 0.5. So what will be mathematical expectation? How much you should expect in A? 20 into 0.8, that is 16%. In case of B, 30 into 0.5, 15%. So from layman's point of view, company B is offering you more return, but if you apply probability, and these values are assigned by the experienced people of the firm, 0.8 or 0.5, how much to assign? They are experienced people. So probability technique will also help you, which you have studied in statistics. So don't study everything from a statistic point of view. You have to learn how each and everything will be used in business. That should be the more concern for you. See how to know the financial risk. All of you have studied in accounting, financial leverage ratio.
Those three classes.
Okay, financial risk. You have studied financial leverage ratio. Financial leverage means debt equity ratio of the firm. Debt equity ratio of the firm. If a company has more debt and less equity and you have invested, it means financial risk is greater. Suppose company X, which is running with 90% debt component, it has loan 90% and 10% equity component, and you are the equity investor in the company. So always there is a financial risk. In case company is not able to earn profit, it has to pay 90%. It has 90% debt component. So on 90% debt component, interest will be paid. Profit is not available, but huge interest burden is on the company. So always equity shareholders have risk, and that risk is called financial risk. So financial risk, financial leverage ratio, you can use to calculate financial risk, and it is calculated by the relationship between debt and equity.